Hello and welcome back to Core Finance. I'm Matt Brown, and this is one of my favourite, I should say, segments of the week. It's when Campbell comes on and explains or discusses three key stocks to look at. You were pretty much on point for all your stocks last week, so let's have a look at three stocks today. Thomas Cook. I think we all need a holiday, but seems to be performing quite well. Some good numbers.
You can see sort of just at the top end of that chart there, I think around the start of September, that was like 26-month highs, and that 26 months covers what was a pretty ugly period for Thomas Cook. Last year and in 2015 as well, but last year especially, that various sort of terrorist attacks around the world, things like that, really weighing, and you had obviously Brexit and stuff like that. Causing fears around sort of UK consumers' ability to go on holiday, weaken pound, yada yada yada, things like that. Since this year, however, there have been signs that the issues that plagued in 2016 are turning around. I think its third quarter figures back in July, summer bookings were up 11%, with places like Greece, Bulgaria, and Cyprus sort of key growth countries. On top of that, they saw an increase in demand for Turkey, and Turkey was one of the key destinations that had suffered in 2016 and had a really negative impact on Thomas Cook. Things like the terrorist attacks in the country and the military coup, like a really nasty situation that completely put holiday makers off. They seem to be returning to the country this year. Thomas Cook also said that it was restarting holidays to Tunisia, and I think that was the first time since 2015 and the attack on the beach there. So, things returning to normal somewhat. I think in that third quarter period, revenue was 14% higher to 2.27 billion, and pre-tax profit losses more than half to 31 million. So overall, very positive. September, its update, I think its sort of winter book to revenue was up 6%. It said it continued to see increasing demand for Tunisia and North Africa, which is what investors want to hear at the moment. Then it's also been quite busy in terms of, it struck a few deals in the last couple of months. It had one with Expedia, which has opened up, I think, 60,000 hotels for Thomas Cook to offer as part of its packages and stuff. And there's also the way it's going to be implemented means that it will cost Thomas Cook less to run its city breaks businesses and its hotel-only businesses. Then talking of hotels, it also struck a deal with Swiss group LMEY. I think as part of the deal, they bought 42% of a German hotel group, Al Diana, and also agreed with LMEY to set up like a sort of an independent hotel investment fund. And that continues what Thomas Cook had said earlier in the year about setting up more of its own brand hotels. They're really pushing into that market. I think as a way to mitigate perhaps reduced interest in going to certain destinations. Well, if Thomas Cook have another revenue stream of the destinations that people are flocking to, then that can help mitigate any losses, if they do arise. In terms of its full year figures this week, I think investors are specifically going to want to hear continued demand for Turkey and North Africa, and how far are those countries away from sort of the pre-2015 or mid-2015 demand that Thomas Cook had seen. In terms of revenue, I think it's meant to be up 9% to 8.5 billion. That's a really healthy jump in revenue. If the pre-tax profit situation can sort of improve as well, there's no reason why it can't, at the very least, keep at its current levels. Obviously, it's drifted away from those 26-month highs in the last couple of months, but we've seen our clients buy around that 115 mark, I think, looking for some good news on Wednesday from Thomas Cook to perhaps send it back to 120.
Good stuff, so we'll look out for those numbers. Moving on, Quiz. I must confess, not a stock that I know, but can you just explain to our viewers who they are, what they do?
Well, Quiz is Quiz Clothing. I'm not quite sure why they chose Quiz PLC instead of Quiz Clothing PLC, because that makes it a lot clearer what it is. It's a new AIM stock. It's sort of following in the footsteps of Boohoo and ASOS. Its IPO was at the end of January. Pretty successful IPO. I think the initial offering price was 160, ended its first day on 190. It climbed to £2 by the end of its first week. However, since then, as you can see, it sort of drifted lower. It's now back around the 160 mark. That isn't surprising. It's only had one update since July, and since then you've had the continued deluge of negative news around the retail sector. So it's going to be hard for any stock to avoid drifting lower.
But these guys are online, aren't they?
Online, interestingly, they do also have 300 like stores or concession stands in the country, but they are having an increasing presence online. In October, it reported its sort of half-year sales figures. Overall, they were up 35% to 56.1 million. So you can see where the comparisons between ASOS and Boohoo, obviously far lower in terms of revenue, but in terms of year-on-year growth, similar kind of story. Online sales were up 204% to 13.8 million. Obviously, I think that will be the key metric for investors in the next year or so, as people perhaps feel out the stock and see whether they want to get on board, and perhaps are looking for the new ASOS or Boohoo. If Quiz can significantly increase its online presence and follow in the footsteps and avoid going down the sort of rather weary bricks and mortar route,
yes,
then I think it can attract more investors. Internationally, sales are up 25% to 10 million. It's got stores in mainland Europe and in Asia, I think places like Hong Kong. In terms of its figures this week, I think in April its full year pre-tax profit growth was around 17% to 5.7 million year on year. You can see it managed similar double-digit growth figure for the half year. I think investors will be happy, can lift away from those 160 lows. In terms of any kind of update, it has mentioned previously about launching in Australia and the US, two pretty fertile markets for clothing, especially if you look at the success ASOS has had in the US. Any launch into that, obviously, it's quite early in its market career to perhaps be looking to move into the US, but I imagine one of the reasons why it launched on the market was to raise the funds to launch in the US. So some kind of update on that heading into the new calendar year, I think will be welcome from investors. At the moment, I think they're probably looking for ambition. They're looking for a continued sort of move into the digital arena. I think that's why we've seen our clients buying around the 160 mark. It could be a stock. Obviously, ASOS and Boohoo are pretty big boots to fill, but there are early signs there that it could be a similar AIM stock, fashion success story, and I think that's what our clients have been buying around the 160 mark.
And speaking of big boots, let's look at small boots, baby boots indeed. Mothercare, stock I do know, and probably a lot of our viewers do, but really a tough ride of things.
Yeah, it's
in the UK and internationally.
Internationally, especially, is where it's got its issues. In the UK, it seems to be sort of turning things around. Its full year figures in May. UK like-for-likes are up 1.1%, and that's down on the 3.6% growth seen the year before, but it's still managing like-for-like growth in the UK. But internationally, like-for-likes were down 4.1%, their total sales down 2.2%. Part of that total sales drop is due to it sort of significantly reducing the amount of stores it has in the UK. I think at one point, a few years ago, Mothercare had 400 stores in the UK. In May, it had 150, and it said that it wants to cut that to 70, that's a pretty dramatic drop. But that goes alongside their push into digital, as we're talking about with Quiz.
Yes,
digital is any company that has a footing in digital and can significantly get ahead of its rivals that perhaps don't have quite so robust offerings online is going to be the ones that perhaps survive what could be another choppy 18 months. In terms of elsewhere, its figures I think it was in July, first quarter figures, UK like-for-like was up 1.9%, so that's an improvement on what they managed back in May, in the full year figures in May. Signs that perhaps that things are turning around in the UK. Also, May, they said that they're really sort of narrowing their focus on like expectant parents, sort of babies and toddlers, because previously their products went up to the age 10 range, and when I was a kid I think they went higher, but they've now cut it from up to age 10 to up to age 4, so they're really narrowing down on that niche, and I think that's probably a wise move. Like it makes Mothercare the go-to place for, and people know exactly what they're offering.
Yes.
They know exactly if I'm at this time in my child's life, Mothercare is the place to go.
And clients, I mean, down here at the 80p level, are they looking at this as a buy, or is this catching a falling knife?
They have been buying around the 80.5 mark. I think because, like I said, the UK like-for-likes were up to 1.9%. If they can manage, with the half-year figures on Thursday, similar, maybe push that UK like-for-like to 2% and manage a decent, like a half-decent pre-tax profit figure. I think back at its full-year underlying pre-tax profit, they eked out a 1% rise, which isn't too bad given, especially looking at the chart, you'd expect something a lot worse. Again, international is where the problems are. It's mainly Mothercare's presence in the Middle East, economic uncertainty in the Middle East. I think that took international sales down 8.3% for the first quarter at a constant currency rate. At actual currencies, they were up 2.2%. So there is, room there for for the figures to be sort of softened
Yes.
a bit. But like I said, our client's buying around the 80.5p mark. If it can manage decent UK like-for-likes, it's done so poorly in the last 2 weeks that it could quite easily bounce and not have gained that much, but still have seen a decent rise on the day of its results on Thursday.
Well, one to look out for. I will certainly be watching the tape to see when they release their figures on that one. But in the meantime, Connor, thank you very much for
Thanks
joining
very
us.
much.